And we're back with another episode. I'm your host, Stephen Rochester, and today I got my guy straight from Cambridge. He came down to chop it up with me. Mortgage broker, real estate investor, my guy Roy Simon. How you doing, my man?
I'm doing good. Appreciate you.
Thanks coming down, man. I appreciate that, dude. I know we've been going back and forth for some time now. I reached out to you last year. We had to carve out some time, and you're in the city today, so I appreciate you coming out, man.
My pleasure, man. Thanks for having me. I like what you're doing, and I'm always gonna make the time to, help spread some information and just be a part of the actual movement.
Yeah, I appreciate that. You've always been online, and we communicate online. Instagram. You do a lot of social media. Educating the community on what they can or cannot do, right? When it comes to purchasing their first home, acquiring a mortgage, and how to navigate through those things, right? I like to bring on the professionals because I'm learning. I can't learn everything, but I can if I bring on the professionals and kind of pick their brain for an hour. You see it. You're at the front line of people applying for mortgages and whatnot. So, the main question people always hit me with is, how's the market? I hate that question, right? Yep. But in terms of people, acquiring their mortgages right now, how is that right now?
Oh man, listen, right now is a pretty interesting time. So, for those who are watching, it's February 2025, and the market's in a pretty crazy place because, we were coming out of a lull where there's just been a lot of uncertainty. Rates were super high about a year ago, and they've been steadily on their way down, and that's really got people's ears perked up. A lot of people are interested in just trying to figure out, where do I stand in all of this, right? Because with so much moving parts, you need clarity to figure out where do I actually stand amidst all of this. Because as you're probably well aware too, not everyone's situation is the same. Yeah. So now it's just a lot of conversations being had, a lot of people trying to figure out, strategies, assessing goals, assessing current situations, to figure out how do we make all of those things align. And right now, it's a matter of everyone who is, has that home ownership goal, whether it's their first property, second property, or just trying to expand the portfolio. It's okay, let me see what's out there. A lot of things have changed. How does this affect me, and what can I do now to get my feet in? Because there's a lot of expectation that things are going to move pretty quickly in the near future. Great.
So you are a mortgage broker. Correct me if I'm wrong. Or were you once a real estate agent as well, or no?
Funny enough, I was conflicted on which one to pursue.
Right.
I didn't know which one I wanted to do. So I actually, before anything, I was a real estate investor. I got my first 2 properties before doing anything in the real estate space.
Huge.
It's crazy. And the reason why I even chose to kind of get into this space was because getting those 2 properties were a nightmare. It was just not a fun and seamless transition or process. And I was really like, it shouldn't be this difficult. Yeah. Not to say that it should be easy, but I should know what to expect or what to really do to maximize and achieve my goals. So I just kind of wanted to be someone that could help others have a more smooth experience that I was hoping to have myself. So I'm a mortgage agent, never been a realtor.
Got it.
Just when I compared the lifestyle that I wanted, I didn't want to drive around a lot. I didn't want to wear suits and ties. And I was like, let me just be at the crib. I was expecting my first son as well. So I was like, let me just go with the more remote option, the more schedule flexible option, which was being a mortgage agent. And I'm glad I made that decision as well.
Yeah. So you talk about, you get your mortgage license. How long did that take?
To get the actual license itself?
Yeah.
I want to say maybe 2-3 months.
So most people can get it.
Yeah, 100%. And that's why, again, realtor versus mortgage agent, the paths are very different because I think there's been a lot of changes on how to become a realtor these days.
1,000%.
And it's a lot more costly.
I just went through it last year, and it's double the price.
Yeah, costly and time consuming too.
1,000%.
Yeah, so I'm like, you know what?
Not the route.
Yeah, I didn't have that time as well when I was expecting my son too. I had just lost my job in the pandemic.
Got it. Okay, so what were you doing before that?
I was working at the bank.
Got it.
And I was also a YouTuber, which is a nice little fun fact. Many people are just like, you do a bunch of content. Like, how do you do this? And I'm like, it's not to flex, but it is natural. Like, I've been doing this for the better half of a decade, right? So it is pretty seamless and natural for me. So yeah, it's just kind of taking that marketing tactic and just funneling it to mortgages now.
You mentioned marketing. You're pretty big online. If I'm going through my feed, I usually see a tip or two from my guy Roy.
Yeah. Appreciate it.
Why the social media? What's the importance to that?
Oh man, well, a couple of reasons. One, my goal and the whole reason why I got into this again was to just help as many people as possible feel like it's achievable, understand the ease of it and how to best position themselves to achieve their goal. And if I want to do that on a mass level, what's the best tactic or approach to reach as many people as possible? It's got to be social media. On top of that, I despise cold calling.
Yeah.
Most
people do.
Yeah,
Most realtors do.
Exactly. It's not my bread and butter. It's not my
Right.
cup of tea.
Door knocking.
Yeah. So I'm like, you know what? Like, if I'm not gonna do this, I gotta do something else, and I gotta go full-fledged into it. So social media was just kind of like the very unilateral decision of just like it checks all the boxes of what I want to do, how I'm trying to reach people, and what do I also like to do more so than the other thing that I can do.
Right.
The alternative is not too appealing to me anyway. So not cold calling.
And it's
videos.
a cost-efficient way of marketing.
Sometimes.
It can be.
It can be, yeah.
Right, when you have a team and they're doing the cameras and whatnot,
Yeah.
but at the end of the day, most people have a camera on their phone.
Exactly.
And they have a bunch of tools online that can help them with the captions and the editing and all these things.
Exactly.
So it's not that.
It's not.
daunting. It
And
can be, but it's not.
Exactly. And I'm glad that you say that, because a lot of people are just like, how do I gotta pay this videographer? I'm like, listen, bro, like, you see my feed.
Yeah.
A third of my videos are like the really high quality videos that are coming from like professional videographers. 2/3 of my videos are made on my phone, in my car, on my couch, for free.
And those are the ones that tend to do the better results.
Agreed.
Right?
Those ones convert just as well, if not better, than the professional videos.
Yeah. So how long have you been a mortgage agent now?
This is my 4th year. Like, so I entered my 4th year. God willing, it's been pretty good. 3 full years complete, 3 straight top performer awards at my brokerage, which is great. So I'm just continuing to climb and just get more comfortable and continue to get my name out there, and it's been great.
All right, let's talk about it. Right, I'm renting right now.
Okay,
like many Canadians, many Torontonians, right? It's a lot of money you got to throw away every year. Damn near $30,000 every year, paying down somebody else's mortgage.
Yeah. Moment of silence for that. Moment of silence for that.
Right? Now, allocating those funds to your mortgage, but the cost of entry nowadays, it's pretty crazy, right? It's not easy for somebody making $60,000, $65,000, $70,000 a year to get into the market, right? So what are some ways where people can position themselves, for success in that realm?
I'm glad you brought that up. It's not an easy transition, right? Like, going from renting into home ownership is difficult because, and you probably seen it as well. The things you need to become a tenant somewhere or apply for a lease, the documents are pretty similar, right? You got to give a pay stub, you got to have a T4, you got to show the income to prove like, hey, I can afford to rent this place out. Right. The mortgage process is more or less very similar, right? Obviously, there's different ratios and stuff you got to abide by to make it work, but at the skeleton of it all is the same. So really the main difference is the down payment. And if you have the down payment, let's say someone who has a $50K savings, right? You have the option to own just as much as you can go and rent. Right. If you're willing to compromise on where and what it is that you're actually willing to acquire. So I think that's really what how I approach things, is just trying to show people the perspective shift of, if you don't have that down payment right now, okay, how can we develop the muscle to save up the down payment, right? Maybe we gotta fix our budget. Maybe we gotta, readjust our priorities, because the money is there.
Get rid of the Netflix.
Get rid of the Netflix. You know what I mean? Like going to the club every weekend, right? Like there's a lot of things that you're making money. Yeah. Where is it going?
Right.
Because it's going places elsewhere than you saving up for your house. And there's nothing wrong with enjoying life and going on vacations multiple times a year and whatnot, but moderation is key.
And what do you want in life?
Exactly. Right. How important is it to you? So that's kind of the approach that I take. And if you're trying to really maximize what it is that you could buy, right? Like you said, if I'm working off a singular stream of income, the majority of homeowners right now are working off the strength of having 2 or 3 streams of income. Maybe Absolutely. It's 2 partners, maybe it's 2 siblings that decide to work together, which right there is something I really pitch to people, right? If you have a sibling that's in close range of age, why not do it together? Yeah. It's much easier to enter the market if you're teaming up with somebody, because 100%. Now we're talking about 2 streams of income, not 1. Yeah. And when we're looking at these prices in certain areas that people desire to be, you got to play ball the way that you need to play ball to make it happen. So if it's teaming up with a sibling or a friend to put your resources together to get into the market, that's what I'm suggesting. Another thing that's really huge as well is being flexible on location. One thing for me, when I bought my first property, I was living in Brampton at my mom's house. Yeah. I bought my first property in Brantford. Right. At about an hour away, everyone was like,
why Brantford?
Why Brant? Well, price. You know what I mean? So it was a fraction of the price of what I could get in my immediate vicinity. Right. And it got me into the market. And fast forward 2 years, I had enough equity to then get the second property and also, have myself in position to buy what became my third property that I bought last year.
So you've done it.
I've done it.
Right.
I've done it. I've
You
seen
can
it
show
happen.
people how to do it.
Exactly. I am the proof.
Right.
So that's something that I would really suggest for people, especially now in an age where, you know, a lot of people have hybrid or remote jobs. Why not be flexible? Take advantage of that, right? Like, we love to not be able to go into the office every day. That could also be your ticket to get a property that's maybe 45 an hour out from where you currently live, and get a lower price point for the same thing. Maybe you're getting a townhouse for $200K cheaper than if you bought it in your current city or your current hometown. And that's the difference of you getting into the market and building equity.
Right.
Because I've seen it time and time again. The places that we're looking at that, like, that's absolutely out of the question, become the places that, like, I guess I got to go there now, because you get forced out of the city. Toronto has become too expensive, even from a rental perspective, for many people. So you got to kind of, you know, have some foresight and think ahead. And that's exactly what you got to do. Just do things today that your future self is going to thank you for.
You mentioned too, you know, having a strong deposit when you're, you know, trying to find a place. I shot a pod with a colleague the other day, and excuse me, we were talking about how much you actually need to, you know, get a mortgage, right? What is the minimum down payment you need to, you know, get a property that costs $750,000?
Great.
Right?
And
The thinking was it's 5% down for first-time home buyers. Those rules have changed now. Can you talk to me about that?
I love it. So you're saying a couple things that I definitely want to dive into. First things first, first-time home buyer. Whether you're a first-time home buyer, second-time home buyer, 10-time home buyer, you do not need to put down 20% down payment. Under the guise, the real specific aspect that lets you put down less than 20% down payment is if this is going to become your primary residence. And also if it's now below $1.5 million. Anything above $1.5 million, we're no longer talking about less than 20% down payment. And if you are not buying a property that you intend to move into, we're not talking about minimum down payments.
So let's be focused on what we're talking about.
Exactly. You got to know what you're buying. That's going to set the tone for what the down payment is. Exactly. So let's just say, okay, cool. It's below $1.5 million and I'm moving into this property, whether I'm a first, second, or third time home buyer. You now are subject to the minimum down payment structure. So anything $500K or below, it can be as low as 5% for your down payment. As soon as we pass $500,000 of your purchase price, now our minimum down payment is going to change based off of what price you're actually buying it at. So anything above $500,000 as a purchase, your minimum down payment is going to be 5% of the first $500K for your purchase, plus 10% of the amount above it.
Quick math.
Quick math.
500,000, $25,000. Right? So
Plus
10% of your 7. That's an extra 10% of the 200.
There you go.
All right, 10% of the 200, which is
20.
So add that together, $45,000.
There you go.
Round up to 50 just to have a bit of extra.
And that's another point that I wanted to touch on too. So the down payment you need plus the cash you need to have are two different things. So that $45,000 for $700K is your minimum down payment, but you're still going to need closing costs, which are, you know, things like paying your lawyer, things like paying for a possible appraisal.
Your realtor.
Well, the realtor, if you're buying, is actually free. So that's another thing as well that people kind of get caught up on is, oh man, like buying a house, the system's not working for me. If you're buying, the realtor is actually working for you and they're getting paid from the seller, not you. So that's a cost that you don't have to worry about as a buyer. So you're paying for your lawyer, you're paying for your possible appraisal, and you're paying for your land transfer tax, which if you're a first-time home buyer, you're going to get a rebate on up to $4,000 depending on where you're buying.
Got it.
So there's some you want to have roughly about 1 to 1.5% of your purchase price as closing costs. So sticking with that same $700K number, let's assume you need about $7,000 on top of your 45. So about $52,000, like you said, to buy that property. Caveat again, if you're buying for $700,000 with $45,000 as your down payment, you need to qualify for a mortgage of $655,000. You see what I'm saying?
Start again.
So your purchase price is a combination of what you have in cash for your down payment plus the mortgage that you're actually taking out. If I'm buying your house for $700,000, you're expecting $700,000. If I have $45,000 of that $700,000, the remaining amount needs to come from my mortgage. And I need to make sure as the buyer that I can qualify for that mortgage by either my own income or who I'm pooling my resources with to buy it with to make sure that I can complete this transaction. And this is why I'm really vocal about, okay, having the minimum down payment is cool. But you need to make sure that for what you're trying to do, the whole picture makes sense. So if you're saying, okay, I want to buy for $700K and I have $45,000 down, great. Let's make sure that you qualify for the $655,000 mortgage, meaning that you need to have a certain amount of income and or not a certain amount of debt. Because if you have debt, it's gonna reduce how much your income goes towards that mortgage.
Right.
So this is why pre-approval is so important at the end of the day, right? Knowing exactly what your situation is as you currently stand. If you're not where you want to be, what can you do to get yourself to that point?
Right.
And this is why it's not just like, okay, I wake up today, I want to buy a house, I'm gonna go buy a house. There's some steps you need to take prior to make sure that you're good.
Right. So saving the money is one. Qualifying for this. So what does it take to qualify for $650,000 mortgage with a $50,000 down?
So good question. And honestly, this is where again, like it's so.
I know it's particular based off of your case, obviously, but just
rule of thumb. Yeah. So in general, right, like you're typically gonna get about 4 to 5 times your annual income in mortgage money.
Okay.
So let's say I make $100,000, multiply that, but let's do 4.5 just to meet in the middle.
Yeah.
You're looking at a mortgage approval of about $450,000.
Not enough.
It's not enough, right? So in that scenario, you should be taking $450 plus 45, combine that together, and that's what you should be buying.
That's what you're shopping for.
$495,000.
Right.
But again, if you're like, you know what, I don't like what I can buy for $495.
So you're telling me if you make $100,000, you can't buy something.
Well, you can buy a condo.
You could buy, sure.
You could.
Sure.
And again, and I'm not saying that you need to.
Yeah.
But if you're like, you know what, condos are not good for you, because I'm not a condo guy either.
You're right.
Then
like
what can I do?
space.
I do too.
I like a little space.
Me too. I'm a townhouse guy. I just moved into my detached. I'm like, I'm good.
Yeah.
But I had to figure, okay, what can I do alternatively to achieve if I don't want the condo, which is why I went to Brantford.
Right.
It's either proximity or property type.
You gotta pivot.
You gotta pivot.
Right. What does your credit have to look like? What is good? I know there's good and bad debt, right? Student loans, credit cards, car loans, Home Depot, all these things are on your credit card, on your credit report, right?
Correct.
From Equifax, TransUnion, whatever the case is. What do you guys use to pull? Is it primarily Equifax or is it TransUnion? Is it both?
It can be either or depending on the lender, but it's primarily Equifax for the majority of lenders.
Yeah.
And credit score, I'm glad you brought that up too, because again, these are like the main pillars of a mortgage application. You're looking at roughly needing about a 680 credit score, and people get over obsessed when it comes to credit.
Sure.
And credit is probably, in my opinion, of the pillars, the easiest, the simplest, the least stressful. Because when it comes to credit from a lender's perspective, you either have good credit or you don't.
Yeah.
And that deciding factor of good versus bad is 680. And that doesn't mean that if you have a 679, you're screwed.
It might vary.
Yeah, it varies. I mean, you definitely want to be on the better side of that number. But I've got clients approved with the bank with a 640 credit score.
Right.
Because it's more so about the story. Okay, like if you got 640, but it's because I had some high utilization because I had to help my mom move a couple months ago.
Sure.
Cool. Like it's understandable, and we can see the track record of prior to a couple months ago, your credit was clean because it shows your payment history, right? So the rule of thumb is you typically want to be around 680, but again, if you're below 680, it's not the end of the world.
Yeah.
But it's still about knowing, okay, what do I need to do to improve, or where do I currently stand, so I know how to navigate going forward.
So you're at a 650, you have a year runway. In your mind, you want to purchase something in a year and a half or so. What kind of things can you do? Obviously, pay down the debt. Never close. Correct me if I'm wrong.
Great. Yep, you got it.
Right?
Yeah.
Never close the actual cards or the accounts.
The only time I would say to close an account is if you inherently know, I can't handle this.
Right.
Like, I know that there's people out there who, like, they got a credit card on their desk and they're itching. I got to go spend.
Yeah.
If you're one of those people, close it.
Close it.
But if you're someone who's like, okay, you know what? I have self-restraint.
Yeah.
Don't close it, because the history along with that card is going to negatively impact you, as well as no longer having access to that card's limit is going to negatively impact your utilization.
Right.
So have it open, have it paid off, leave it.
Small balance maybe.
Exactly. Use it, pay it off. Use it, pay it off.
Right.
Small balances, you're golden.
Right. You have a $10,000, cumulative credit debt, right? What's a good utilization score on average? Like, you have $10,000. How much of that do you want to have carry a balance?
Yeah,
maximum.
I mean, if possible, you want to be around 30% utilization or lower at all times. So if you've got a $10,000 card, you want to be around 3,000 or less, which I think is more than reasonable, right? So that's kind of that's where you want to be. I mean, again, not to overreact. If you're at 40% utilization, it is not the end of the world, right? And this is where
At
like
90, it's an issue.
it is, yeah. That you might be getting close to the end of the world in that case, right? But and this is why, like again, like I know credit can be a really touchy subject.
Right.
I mean, finances in general are really taboo. But a lot of what I do is just letting people know that it's okay. Where you are right now is not the end of the world. What's really problematic is you being wherever you are and you thinking it's a problem and not doing anything to actively change it.
There you go.
And not seeking the information.
Right.
So like, having this conversation now is perfect because people can very clearly know, okay, 30% utilization or lower, I'm good.
Yeah.
I'm gonna have the best reflection on my credit score. If I'm at 70% or higher, which is where you don't wanna be, I gotta work my way down to getting from 70 to 60 to 40 to 30, and now I'm getting into a better range and improving my credit score.
Right. I had a conversation with my mother. We're talking about whether to go with a big bank or private lenders, the A, B, C, D, E, F, G banks of the world.
Yeah.
Right? Are you a mortgage broker or do you work with a specific location business?
So I'm a mortgage agent which has access to a bunch of different lenders. A lenders, banks, monoline lenders, B lenders, private lenders, and a whole bunch of different lenders, right?
Sure.
But the gist of it is I have access to whatever solutions are out there that you may need.
Right.
And
So you shop the profile around.
exactly.
Like you're getting car insurance, the guy would go find you.
Exactly.
find
Same
you that.
concept. Same concept. Yeah.
Right? And then do you work specifically with the red bank or the blue bank or the green bank? Does it matter? Or is it different? Like how does that work?
So it's never about having, granted having a preference for a bank because of how their product functionality is one thing, right? Like being able to say, okay, you know what, I like Bank A because they've got great prepayment privileges, they typically have decent rates, and they're really lenient with how they, look at credit score.
Sure.
That's one option, right? Sure. But making sure that I still make sure that I'm taking a client to the lender that best suits their particular situation. So for example, I had a client that we recently closed in December, single mom, and she'd been fighting tooth and nail to get into the market for, I want to say about 2 years.
Right.
Her problem was great credit, solid enough down payment. She already knew where she wanted to move. The numbers make sense on paper. The reason why it was so difficult for her for the 2 years was because she's an entrepreneur.
Got it.
And her income on paper looks one way, but how she actually conducts herself from a business standpoint is much better than that. And some banks were struggling to recognize that. So they would pretty much give her a mortgage approval much lower than she should really be earning.
How do you get around that?
How you get around this, and that's exactly why I'm glad that I'm in my chair where I have access to multiple different scenarios and different resources and different programs. Yeah. So we took it to a lender that specializes in self-employment income, and because they were able to look at her bank statements as opposed to what income is on her tax documents, because let's be real, most entrepreneurs, we're not declaring every single dollar of income and paying taxes on it.
Don't tell them that.
I'm unapologetic about it. Find me.
Don't tell them that. I claim everything by CRA if you're listening, all right?
Everything. But so what was really important for that situation was finding a bank lender that was going to be able to recognize from her bank statements, hey, you've got invoices here, you've got a very clear flow of income coming into this account, your business account. We don't care what's on your tax documents. We understand how you're gonna make the money to pay for this mortgage that you're gonna take out, which gave her a mortgage approval that was nearly 200K higher than where she had gotten before. And that is the difference in her getting into the market and not getting into the market.
And the difference of working with someone like yourself that can shop her around.
Exactly.
Right.
So, and this is where, again, like a lot of people in, previous generations, I won't, be too specific.
I try to not have those conversations because my mom watches, all right?
I'm tired.
I try not to shit on mom too much.
I'm tired. I gave up. I'm like, listen, you got it. You figure it out yourself then. But like a lot of our parents and previous generations, they hear broker, and I understand why. In the past, it was much different as a broker. But they think, okay, I'm going to get put into a private mortgage. It's going to be expensive. I'm not even looking at this option. But now, mortgage brokers have access to everybody, banks included, and it's actually to your detriment to not use them. Because if you're someone that's like, you know what, I've been with the green bank for all my life, and they've never steered me wrong.
These are the conversations I'm having, is what I'm saying.
I've had them too.
I know.
It is its own battle.
Yeah.
But when you do that, you pigeonhole yourself to only what that bank can do for you. And there's many situations where that bank might not be able to assist you in the best way according to what you want to achieve.
Right.
And you're really only just hurting yourself. So having access to a broker who has access to everything for you is the best way to get the results. And also, like, many people are like, okay, the cost, the broker's gonna charge me a very huge fee. I don't know what other brokers are doing, but if I'm doing your mortgage and we're going to the bank to get your mortgage, the bank actually pays me on your behalf. My services.
And I was gonna ask you, how do you support your family doing this?
Yeah, and I love that. So it's, again, helping out my community and helping people achieve their goals, and also not needing to dig into their pockets, right? So anytime I do somebody's mortgage and we get it done at the bank actually pays me the finder's fee because I chose to take my client to that bank versus any other bank. And that means that I don't have to charge the client directly because the bank is paying me. And I would much rather take the bank's money than take your money.
Absolutely.
So, and it's just like a realtor when you buy a house, right? The realtor's not getting money from the buyer directly, and I'm not getting paid from the buyer directly. The bank is paying me, and the selling agent is paying you the commission. Exactly. So again, as a buyer, you have access to all of these resources through us, and it's of no cost. So again, like, just making sure that you're having the conversation.
Debunk the myths, please. Like,
I'm here for it because it's a lot of people being held back by themselves. And I know a lot of people want to point fingers at it's unfair, it's really expensive out there, and granted, all those things are true. But there are also a lot of things that are out here that are here to help you overcome those hurdles.
You just got to get educated.
Exactly, and reach out, have a conversation.
Okay, question for, what's the best rate now to get? Right, so you get a pre-approval, you can do a little shopping. Variable or fixed? That's the question. Variable or fixed? Every other month they're dropping the rates, they're increasing the rates. You're going left, you're going right. So what's the move?
Good question, and honestly, like, I have this conversation. You could probably imagine how much times I have this conversation 100%. A day. But the answer is, and don't shoot, but it depends, right? And really, what it depends on is, yes, there's things that we could talk about that are like, okay, what's the expectation going forward? If I go variable, will the rates continue to drop? Will I end up the winner? And then there's also the conversation that needs to be had, which is much less quantitative, which is, are you comfortable? Because going variable, yes, we are expecting that rates are going to continue to go down, and you'll end up with a better rate long term throughout your term length. But are you going to be able to sleep at night?
So not knowing what the pros and cons to that. Let's 100%. Let's deal with fixed. What's the pros and cons to fix?
So the pros to fix is stability. You know predictably every single month for however long your term is what your mortgage payment is going to be. Someone, even like myself, I went fixed and I closed my mortgage 5 months ago. And the reason why I went fixed is because I just want to know what my payment is every single month. It could go down, yes, but it could also go up. I want to play it safe, and I'm going to get my lock in for 3 years. And I'll reapproach this again in that time frame in 2027.
So not to be in your business, you do a 3 or a 5.
Fix. You could do 1 to 5. It could be however long you see fit. There's term lengths from 1 to 5 years. Every term length has its own corresponding rate to it. The reason why I went 3 was the lowest that I would get without it not pretty much compromising my flexibility going forward. So if I went with 5 years, I'd be in that rate for 2 years longer. I was like, I'd rather be able to get a new rate.
3 years, at that point, you can, pick a side.
Exactly. I can change. I get to choose again.
Are you doing your own mortgage?
Of course, I did my own mortgage. This is my first time doing my own mortgage.
I love that.
So it was cool, and it was also interesting to kind of be in my client's seat.
Right.
So that was interesting. But yeah, I went fixed for that reason, for literally just the stability aspect. The downside to fixed is, and this is one of the parts of the conversation that I think is really important, is for the term length that you're choosing, do you plan to keep this mortgage for that long of a time frame? Because in the event that you need to break your mortgage, the penalty is much larger. So if you take a 3-year term and you break your mortgage, which means, and you break your mortgage by either refinancing or selling your house. And if you break your mortgage 1 year into a 3-year term, and the penalty is now 20 grand, for example, because it can be that large.
Yeah, they got to get their money.
Exactly.
They're waiting for the interest.
And you signed a contract.
Yeah.
And again, this is why when people say, I'm loyal to bank B, C, D, I'm like,
I'm not loyal to any of these guys.
Like, they're not loyal to you. They're making you're a transaction to them. So when you break your mortgage 1 year into a 3-year term, and they say, okay, here's your $20,000 penalty, shocked you. But if you had already known, and granted, sometimes we don't know. So maybe that's the benefit of a variable in that case. is like, you know what, I don't know where life's taking me over the next couple of years, let me just go variable so that in the event that I have to break my mortgage, my penalty is rather minimal.
So when you're signing these contracts, do they not let you know what your potential penalty can be?
So when
is it a percentage? Is it a...
And for fixed...
How do they calculate this?
For fixed, it can't be calculated because it's all going to be dependent on when you break that mortgage. But if it's variable, you can calculate what your mortgage penalty would be at any given time because it's going to be strictly 3 months interest of your mortgage payments. And you get your amortization schedule, which shows you how much interest for each payment there is.
Right, so calculate it.
Exactly. But for fixed, you don't know. So that's what makes it expensive. Exactly, pros and cons. So if you're someone who, again, is unsure of, okay, maybe I might sell and buy in 2 years, maybe you should go variable in that case, or get a 2-year fixed term.
Pros and cons to variables, real quick.
Pros and cons to variable, you get to ride the rate down, just like right now, your payment will presumably go down, or your interest to principal percentage will go down.
Yeah.
Your mortgage becomes more beneficial to you when rates go down.
What's the rate right now?
Right now, it depends on every bank is gonna have a different rate, but the overnight lending rate is 3%.
3% from how much did it drop in
It
the last
dropped like
2 years?
over like 2%. It's like 2%, I believe.
Yeah, and that's huge for people.
It's huge. That's a lot of relief.
Yeah.
Because remember, it went up. So a lot of people were ending up with a payment that was here and it trickled upward and upward and upward until it got to a point where they were in over their head. And now they're finally kind of coming down and, either restoring balance or maybe they just have relief overall.
Yeah.
And that's the benefit, and that's the upside and downside to variable. Is it's great when rates are going down, but like many people experienced a 1.5 to 2 years ago, when it went up, it was like, what do I do? It was painful. It hurt. So that's the benefit and also the detriment to it. And then also you get it's usually a more cost-effective penalty when you are breaking that mortgage.
Got it. When the hikes are up and people are renewing their mortgages, last year, maybe earlier this year, are you seeing that? Are you seeing how many people weren't able to renew their mortgage? I know that that was a horror story for a couple months as well, right?
It was really bad because you got to see a lot of people and how the effect of that variable from the negative perspective, how it impacted people. Because when your mortgage payment goes up, you're going to make that payment because you got to keep your roof over your head. But if you don't have the money to make that payment, what do? You draw from your line of credit. You draw from your credit card. You have to go get a second and third job, and now you're just exhausted. And I had people coming to me that were coming up on renewal trying to figure out what their situations could look like now that they've met this point where they can finally get some relief. But in that moment, they're like, dang, I have 40 grand of line of credit debt now. I never had that before. But that's what you had to use to kind of keep up with your payments.
Stay afloat.
So exactly, and you saw people that really just ended up drowning in other debts just to keep up with their mortgage, which now they're like, well, now I gotta refinance to wrap all those debts into my mortgage now, and now I have a larger mortgage than I had before. It's
crazy.
And that's why you gotta make sure that you can really live within and below your means so that you don't end up in these situations to begin with. But it all starts with the basic principles of money management.
Yeah. So at that, with all this data, is it still wise to rent? I mean, to purchase, to buy?
Well, I think whenever you're looking to buy a house,
I know there's pros and cons to both.
100%. And if you're somebody who, let's say you're somebody who's like, you know what, I don't have my bearings on my finances, I can't adjust if something was to kind of hit the fan.
Right.
Then maybe there are situations where I tell people you should probably rent. And
put your money somewhere else, maybe.
There's no exactly, or maybe you buy something and rent it out to somebody else. Make them handle the responsibility of it and have them pay down your mortgage.
Yeah.
Right. So I think that there's always alternatives. I'm very you're never gonna find a scenario where I'm like, real estate doesn't work. Period.
No, of course
for you.
not.
You know what I mean?
Not.
There's gonna be something that you can do to make it fit for your lifestyle or your preference.
Yeah.
But if you're somebody who isn't financially savvy, real estate can definitely eat you up and spit you out.
Crazy.
Yeah.
Doing, actually getting a property, or I was talking to a colleague the other day where we're talking about, is it wise to rent and purchase somewhere and rent that out, right? You mentioned that just now. What's the difference when you're trying to get a mortgage and it's not your primary residence?
Good question.
I want to move back to mom's
Yeah.
and save the money and purchase something and not live there because I don't have to.
Right. And I mean, I'm very candid. I'm very transparent because I know what I can and can't do.
Yeah.
So, for example, I'll tell you about my own instance as well. So, when I bought my first property, I stayed at home with my mom because I wanted to have that rental income, extra stream of income to help me save up for the next property because I always knew I wanted to be able to, build wealth through real estate. If you're somebody who has that intention as well, if the property is in a vicinity Like, let's say you're living in Brampton and you're looking to buy a property in Hamilton. Sure. 45 minutes, an hour out. You could say plausibly you're moving into the property, and that might be the difference between you being able to buy it for 10% down payment and 20% down payment. Because remember, if you're buying a rental property that you're claiming as a rental property upon purchase, you need 20% down payment.
It's an investment at that point, right?
Exactly.
So it's an investment property.
And if it's going to be an investment from the lender's perspective, you need at least 20% down payment.
Right.
But if you're somebody who is adamant on putting down less because either you don't have more money or you just don't want to spend more money, you need to make sure that you're buying a property in a reasonable vicinity so you could say you're moving in, or be fully remote so you could say that I'm moving in. Because if you cannot say that you're moving in, you need 20% down payment.
Right.
So in a situation where somebody wants to stay at home or even continue to rent, if you don't want to pay 20% down payment, which if you're okay paying 20% down payment, then it doesn't matter. But if you're like, I have 15% nothing more, or have 10% nothing more, then you need to either be remote or it needs to be in a radius from wherever you go to work to be able to plausibly say that you're moving into the property.
What if you move in there for a year and then you exit after that year? Does it matter?
No, it doesn't.
Are they in your business?
And they're not in your business like that. Listen, all banks care about is, are you paying that mortgage?
My point exactly.
Yeah.
These are, I know the answers, but I need to get it from the professional.
You need to get it out. Yeah, like as long as that check clears and that payment is in the bank's hand every month,
they're not knocking on your door.
They're not knocking on your door. Who you need to be careful about is the government. Yeah, they got to make. They're the ones that's really going to double check and make sure. Like, okay, did you skip out on your land? Did you get a land transfer tax rebate that you weren't supposed to get?
Right.
Did you bend the rules to make things work for you in your favor? That's what you need to be more mindful of.
Yeah, they will knock. They will send a letter.
They'll play detective, right? Like if you're saying you moved in somewhere but your address didn't change, or
nothing was updated, driver's license.
Exactly. Nothing. Or you got somebody else living at your place who has your address and every bill is in their name and the government also does their taxes.
Be smart.
You know what I mean? Like you gotta
play the game a little bit.
Play the game. If you're gonna play the game, play it properly.
Yeah. 30, 25, what's better? Obviously, I would go with a longer, stretched out mortgage. But what's the pros and cons to that, right?
Great question.
I know they introduced this a few years ago, where it was usually 25, correct?
Yeah. So this past December, they introduced new rules for first-time homebuyers to get access to 30-year amortizations with less than 20% down payment, which before you had access to 30-year amortizations if you had 20% down payment. Now you can have it with or without, which is great. And in my opinion, I like this change because I always like going with the longer amortization because it shrinks your monthly payment, makes things more affordable. We're here talking about how expensive it is, period, right now. If you can cut costs somewhere, it's great. And then the thing is, I get it. People don't necessarily like the idea of being tied to a debt for 5 years longer. Well, what you can do and what almost every lender has as an option as well are prepayment privileges, which now gives you the opportunity to make extra payments to that mortgage and that excess that you pay goes straight to the principal. So this is a strategy I gave to my client literally like 2 weeks ago because they bought the house in December. They don't close until I think a week or two from now. So they've had some time to kind of mull over options and new things have come into place since they bought the house. So he had a 25-year amortization originally. Now that he can get 30 years.
Oh, you can go back?
I can change it, yeah. Nothing is final until you close on your mortgage.
Okay.
So everything is subject, if you want to change from fixed to variable, he could do it before closing.
Yeah.
So long he still qualifies. But nonetheless, he now has this 30-year option on the table that he can now pivot to.
Yeah.
And we're making that pivot for him because of these two reasons. It now gives him a monthly payment that is $300 cheaper. And yes, that does add 5 years longer on his amortization schedule if he follows his payment schedule. He has the option to make up to 20% prepayment privileges every year. He doesn't have to, but he can go that.
He has that window.
He has that window, exactly. So what I told him to do is take this new payment that is $300 cheaper, but still make the old payment that it was supposed to be originally. Because now $300 every single month will go straight to principal on top of what is already scheduled to go to principal, which will actually have him pay off his mortgage faster than even the 25 years. So there's a lot of flexibility and strategy that you can put behind your mortgage. If you're not enticed by the idea of paying something for 30 years, there's always something you can do to shorten that span of time if you have the urgency to do so.
And again, if you're looking at this property for an income, a rental income perspective,
there you go.
Who cares how long it is?
Exactly.
Let it be 60 years. I don't
Facts.
care, right?
Exactly.
Because somebody else is paying down that mortgage, and you have the ability to refinance and all these incentives.
Exactly.
Right?
And I think that there's nothing more valuable in this day and age, in this economy, than having the luxury of, in his case, saying, you know what, like he has the intention to make the $300 more than need be payment every month. Nothing is more valuable in this economy than being like, you know what, I had a rough month this month. I don't have the extra 300. I don't have to make that 300. I don't have to.
Yeah.
You're not required to. So if let's say it's this December coming up in 2025, he's like, you know what, I got a bunch of Christmas shopping to do.
Yeah, I need an extra 3 right now.
Everyone's December is more expensive than any other month. So having the flexibility to be like, you know what, I'm gonna scale back on what I pay back this month is a huge value add. So I'm always in favor of going with the lower monthly payment, because you also still have the ability to pay more and just pay down the mortgage faster if you have the wiggle room to do so.
Great. Myth or no myth, your student loan hinders you from getting a mortgage. Can hinder you from getting a mortgage.
So answer, it can hinder you.
Sure.
How much it hinders you? Sorry, let me finish this first.
You know what I mean?
So answer, in short, yes, it can hinder you. Does it always hinder you, or does it hinder you significantly? My answer is more likely than not, no. And the reason why I say that is because your student loan is one of the few things that you actually have the potential to change the payment to. So the difference between a car loan and a student loan, and these are both two examples of installment debt. And an installment debt is basically any debt that you have a fixed payment to. So you have a car loan and you have a $500 monthly payment. Your payment is $500 every single month, no matter if your balance is $60K remaining or $2,000 remaining. Right. Meaning it has the same impact regardless of the balance. Same thing with the student loan. But with a student loan, you have the ability to call them and say, hey, can I reduce my payment?
Or can I increase it?
You can increase it, which then would impact you more. But if you reduce your payment, you now have the smaller payment that is going to be affecting your mortgage approval, which actually increases your approval. Because it's always it's all about debt servicing ratios, which is basically, think of your income like a pie. How big are the slices of pie that are going towards other financial obligations? If you shrink the slices of other debts that are going towards your, coming out of your income,
it's more money to your mortgage.
Exactly. So what I've actually had some of my clients do is say, okay, what's your OSAP payment right now? And they're like, oh, $300. I'm like, give them a call. Ask for the lowest payment you can get right now. Sometimes it goes down as low as $40.
Yeah, let me get the buck 25. Let me get the $75.
and this is the trick as well, right? So you want to make sure that you don't just freeze your payment. Because if you say, hey, I'm just going to suspend it right now, I'm not trying to pay it at all, then if there's no payment but a debt, the bank is going to look at 3% of the balance as your payment. Because they know that you got to pay it at some point. They're not just going to assume no payment at all. So you want to just get the smallest payment possible.
On paper.
On paper.
Got it.
And after closing, you can go call them back and put it back to what you want it to be afterward. After you close on your mortgage, it's done. It's a done deal. It's binded.
Got it.
You can now go and change your payment on your OSAP if you really want to. Most people are not going to go to do that. They don't care. It's mostly, in many cases, I don't have OSAP.
Get their money when they get their money, man.
Yeah, I don't think there's interest on it anymore. I don't even know. Some people have interest-free
OSAP get their money when they get their money, brother. I just need to know whether it's going to stop you or not, right?
It's
like full stop.
Yeah, and the only time I've seen it really be a full stop on people is when they have a very large balance and they don't have a payment active. Because if it's a $90,000 student loan, maybe they went to law school or something like that, and it's not a repayment yet, once the bank looks at 3% of that balance as your payment, you're cooked. So that's the only time I've seen student loans be a hindrance. And again, on that same note, the bigger hindrance that I see across the board is car payments.
Car payments. I was just about to ask you about that, right? So getting the new BM 7 Series, not a
new Benz, all this, new and
it's not a good idea.
Get it after the house.
Don't even get it at all.
If you want it don't. And listen, as someone who owns 3 properties,
Hot that shit.
I drive a 2019 Honda Civic that I own outright. Listen, I feel like I'm in a Bugatti when I'm in it. I don't care because I ain't got no payment to pay other than my insurance and my gas.
These new cars have all the bells and whistles more than the BMW and the Audis and all that stuff.
I'm telling you, all the same. Yeah, you're paying for the emblem. That's really all it is. And granted, don't get me wrong, I'm gonna get my little Mercedes in the future. But when I achieve everything else that I really want for myself, that I know the Benz or the Beamer is holding me back
Trying to
from.
be rich, not look rich.
Yeah, then I'll go get it after everything else is
1000%.
done. But getting it first or on your journey is always going to hold you back.
Yeah.
Because again, going back to debt servicing ratios, that's a slice of my income, a slice of pie of my
These
income.
payments are not
gone.
Little $200 payments,
Like,
guys.
I'm
These are
seeing
$1,200.
4-figure monthly payments.
Madness.
Yeah, it's crazy.
Madness.
It's crazy.
I was gonna ask you about fuck, I'm blank here right now. It was right on the tip of my tongue. You mentioned something about, where is it?
Honda Civic.
No, man, I forgot what it was. I was right there, but we said something we strayed off. I was talking about consolidation. It was a debt, right? You posted a video the other day about, whether or not it's
Consumer proposal?
Consumer proposals.
Ah, yes.
You posted that the other day. I know a few people that got it, right? And whether it's the time has passed or not, they got it, right? It's not a good thing to get.
No, I mean, you can definitely, and again, like everything.
This is one of the things where people it's overwhelming, so they go to the ad,
trustee
the ad
and
that just came up on YouTube.
And that's the part that's so scary, is like everything is so accessible, and social media's made everything in your face, right? And if I'm somebody, I could have easily been someone. I watch YouTube while I'm doing the dishes, and I could be someone who could have very well been overwhelmed by debt. Saw that ad mid-dish scrub and be like, oh, solution.
Right.
Seemingly. Yeah. And the problem with the consumer proposal is it's like a step below a bankruptcy. So even though you're consolidating all of this debt, and yes, it does reduce how much things you're paying, you still have a payment to make to pay off now this one debt.
Right.
And it's a stain on your credit.
That's what it is.
And it's a stain for as long as you're paying it off, and for 2 years after you finish paying it off.
Right. Some of these are for 9 years, 5 years.
Exactly.
Plus the 2 years.
And the thing is, I hate the fact that they've given it this term and they have this connotation to it, like it's okay. Because as soon as people hear bankruptcy, their ears perk up. They're like, no way.
You can't touch them.
But you don't have that same reaction for consumer proposals when they do very similar things
And
for
you
you.
should.
You should.
Yeah.
So when people have a consumer proposal, granted, yes, it can help some people climb out of a really sticky situation.
In real time.
Exactly, but it's all circumstantial, right? Like I've seen people that do consumer proposals because they had 6 figures of debt to consolidate and wrap up. Cool, I get it in that scenario. But I've also seen people who had 20 grand worth of credit card debt.
Yeah, 4 cards for $5,000 each, right?
Yeah, and then they wrap it into a consumer proposal.
Right.
That is manageable, in my opinion. I would never justify wrapping up $15,000, $20,000 worth of credit card or line of credit debt into a consumer proposal, because now that relief is there, you're like, oh, I'm out of this debt. What do I want to do next? I want to go get a car. You're not going to get a good car loan interest rate because of the consumer proposal. And now you're going to pay a very hefty fine monthly or hefty fee monthly for that car loan because you got double the interest rate because of your consumer proposal.
Yeah.
Or maybe I'm like, okay, cool. I've righted the ship. I'm ready to buy a house. You're not getting a bank mortgage for at least 2 years.
Jeez.
Because the bank, no A lender is giving you a mortgage until 2 years after you've paid off your consumer proposal.
Right.
So if you're somebody who gets a consumer proposal today, but then let's say you know that was your epiphany, and you've righted your finances, and now in 2026 you're ready to buy a house. It's not going to be with the bank.
Yeah.
Because they're going to see the consumer proposal and be like, no, that's too recent of you to have a consumer proposal for us to feel comfortable giving you a mortgage.
And you still got to wait
of
2
any
years
size
after that.
Exactly.
Jeez.
And you have to think, what are prices going to be in 2 years after that?
Oh, come on. Based off of the trends, we know it's going to be damn near
Exactly.
whatever, X.
Exactly.
Right?
Whereas maybe if you just put your head down and paid off the 20 or 15 grand's worth of debt yourself without the consumer proposal, in that year, you could have bought that house with the bank.
What's they're, again, these consumer proposals, they're wrapping up your debt, but they're still giving you a payment, right? So how can they get it so low? Are they striking a deal with Capital One and TD, and how does that work?
It's a combination of things, but also too, like when you think about, and where it really becomes a valuable solution to people is if I'm paying 6 or 7 things, it's overwhelming.
It is.
I'm probably missing payments because I'm forgetting, or it's just the stress of it as well. When you wrap it into one debt that has one interest rate, maybe that interest rate is lower than some of the things that you're paying off, maybe a little bit higher than some of the things. Like when you compare them holistically, the payment for all 7 things in one scenario versus the payment for this one debt for this one thing,
Yeah.
maybe the payment's a little bit lower.
Yeah, that's more manageable.
Exactly, and also you're focusing on one thing.
Yeah.
It's less tedious. So that's really what the
That's
result
the
it
aura
gives
to
you.
it is like that's why, right? People will love
Exactly,
that, right?
exactly.
But you wouldn't recommend that.
I wouldn't recommend it unless it's an extreme circumstance where, like, again, we're talking like 6 figures and there's absolutely no other way out. Cool, go ahead.
Bankruptcy not happening. You're not getting.
I'm never co-signing bankruptcy. 7 years, crazy.
No.
And bankruptcy is so scary in the sense that I've actually had a client who had a bankruptcy. The entire 7 years passed.
Yeah.
And banks were still saying no because it's still
It's a
a stain.
stain.
It's a stain that some institutions will never overlook it.
Jeez. Right. Okay. So you're on your third property now. What are you looking to do next? Are they all homes or townhomes? Detached? Are you doing the condo thing? Are you getting into the commercial? Like what?
Good question, man. Honestly, I'm so scattered with my goals, but I have my townhouse in Brantford.
Yeah.
That's rented out, and I love that you're asking this question because I have a video I'm dropping on the weekend.
Hell yeah.
I got a couple in the tuck.
You're back here on Saturday. You have an event. We'll talk about that.
Yes, I'm coming on Saturday. So I have. I just like to share about like all the ins and outs. Like I'm a very transparent person. So for context, I got 3 properties. I live in one right off the bat. Primary residence, not counting it as a rental property. Got the townhouse that I used to live in that I turned into a rental once I moved into my new house.
Right.
I'm actually like net negative about $600 every month on that property.
Sure.
You know what I mean? And that's the part where people are like, oh, like you're a real estate investor. You own properties. You're rich.
Nope.
I mean, it's not bad, but I'm definitely not I'm not rolling in money like people think I am.
Yeah.
So on that property, I'm net negative about $600, but I'm keeping it because
And why is that? Not to be in your pockets. Is it just
no, of course.
right?
The real reason why long term is one,
You're not charging enough rent.
not even that. I think I'm getting a reasonable amount for especially the quality of tenants that I have in that property. But the reason is and this is where again knowing the long term value of real estate is so important.
Right.
Not every single time are you going to be cash flowing on a property for your entire possession of it.
Not in Toronto.
The reason why, exactly, and the reason why I'm not cash flow positive on it is because I had refinanced it, took out some money to buy the second property and pay off some debt and just get a clean reset on me. So I have a higher mortgage on that property than I should.
Sure.
But also rates went up and now they're trickling back down.
Yeah.
So what was about $1,000, maybe $1,100 net negative before is now $600.
Sure.
And if rates continue to go down, I'll be break even.
Yeah.
And if they continue to go down,
makes
I'll be
money.
cash flow positive.
Yeah.
So you got to hold through the rough spots to get to the greener pastures.
And that's just being a savvy investor, right? You got to know that
exactly.
bad days might come, brother.
Exactly.
will
They
come.
will come,
They
and you got to be
will come.
prepared.
Yeah.
And also on top of all of that, the cash flow perspective aside, that property I really want to give to my son. Like he's 3,
Legacy.
turning
I love
4 in
that.
March. Bro, if we're talking here about how much will prices be in 2 years,
Right.
what will prices be when he's 20 years old?
Yeah. 15 years, whatever the case
Exactly.
is.
And there's nothing more than I envied as a kid growing up, or not even a kid, but like teenager becoming a young adult is like my friends, their parents just gave them a property. I'm like, yo,
they
like,
just got a condo.
that's the dream.
They just got the keys to a condo after college.
Like, you own this? Like, yeah, my mom gave it to me. What?
Right.
I want to do that for my son.
It's not for us, bro. Well, it is for us.
I'm gonna make it for us. You know what I mean? So that's the long-term goal with that property. But I also own a triplex in Sudbury.
Okay, gotcha.
And this is also another thing that I like to talk about too, because everyone is like, we're talking about buying in the GTA and prices are crazy.
Yeah.
Bro, I went to Sudbury
Right.
because I got a triplex, which is 3 units, 3 separate tenants in the one house.
Oh yeah.
For less than $300,000.
Mad.
Like, you have to go to where it makes sense sometimes. And I did all of that while living in Brampton, and I found a realtor out there.
Yeah.
I figured out how much money I needed. I found a property.
The potential rental incomes you can get for it.
I ran the numbers.
course.
I took a serious interest in how to make this work for me.
Yeah.
And like we've been talking about on this entire episode, asking the right questions, talking to the right people, and taking action.
Yeah.
That's really all it is.
A triplex is huge, brother.
Thank you. I
That's
appreciate
like-
it.
Now you get to the 10 doors and all that stuff, right? So is a triplex considered? It's not commercial.
No,
at
no.
that point.
Commercial is 5 units and above.
Gotcha.
So that I got a regular mortgage for. So and that's the beauty of it, right? Like I'm here talking about the Brantford property is net negative $600 a month.
Sure.
That triplex, I'm making about $1,000 a month on it, after expenses paid.
Yeah.
So yeah, I'll take this loss because this gain every month is larger and actually covers that loss for me.
And you have 3 properties that are appreciating over time as well.
Exactly. Someone else is paying the mortgage down on those properties too.
Yeah.
Not to mention, I'm still making money from what I do for a living.
Yeah, it's not like
you know what I mean. Like,
you're not paying for all three. Right.
These are all passive streams of income.
Yeah.
On top of what I actively make.
You're doing it smart.
You know what I mean? And this is why, like, and this is what people always say, like, I want that for myself. Yeah. Well, let's talk and let's figure out how you can, because you can.
How do you get the first one?
Exactly.
You know what I mean? How do you get the first one? Take out, refinance, potentially get something else. There's no tax. Well,
no, there isn't.
If I'm wrong.
You're correct. There isn't.
Right?
Because you're increasing your mortgage. You're actually taking out debt.
Yeah.
It's in the form of cash that you then have to decide, what am I doing with it?
Yeah, you can go to casino
and blow it, and now you just took out more money for no reason.
Right.
And yes, you skipped out on tax, but you got to make sure that whatever you're doing is intentional and actually getting you in the direction that you intend to go.
Yeah.
So, yeah. First,
tax. So
getting in first.
Refinancing is tax-free. Purchasing a new property. Now, your triplex, is this 20% down because it's an investment property?
So again, like, and this is where having strategy in place makes sense.
That's what I'm asking.
If you're
to know the strategy.
Yeah. If you're someone who's remote,
yeah,
like I was at the time,
yeah,
you don't need to have 20% down payment. I can say
yeah.
I'm moving over there. I'm moving into one of the units.
Yeah.
So you could have. I bought it for $268. You have a 10% down payment. What's that? $26,000.
Where do you find a triplex for 300?
And you know,
show me where you find that right now. Please.
I got you. And again, like, just keeping your ears open, right? Because
being around the right people.
Exactly. And that was 2020, 2021.
Yeah.
2021. Again, you're not going to find that for that price now.
Yeah.
It's been four years since. Mm-hmm. But that's why you got to do what you want to do now. Because when you look back 3-4 years ago, you're like, damn, that was the price back then?
I'm glad I did.
You know what exactly.
Yeah.
So, and it doesn't mean that you're too late to the party. Because on that, and again, keeping my feet on the ground, keeping my ears to the streets, the realtor that helped me out with that purchase, still in contact with him to this day. He knows I'm not from Sudbury, but he knows I'm still I'm an investor. Like, I still, like, if I see a deal, I want to know about it.
Yeah.
There's a duplex on that same street, 3 or 4 streets down, 3 or 4 doors down from my triplex, that came up on the market for sale the other day.
Yeah.
And it was about $350. And granted, I'm currently saving for my wedding in September this year.
Don't worry about that, man. Go get the
wifey would never forgive me. But, like, you know, if I was someone who wasn't saving up for a wedding right now,
you jump on that.
Pouncing on that.
Yeah.
And that's why you got to know what you're doing, stay ready, because them opportunities are going to come.
They're coming.
And they're there.
Jeez. You got to show me that listing.
Let
me see
that.
We'll
talk off camera. I got you.
Honestly. Yeah. But we want to give everybody access to, you know, what you have to offer, right? Flyynancial. Talk to me about that.
Flyynancial Solutions, man. Honestly, so it's just all about, like, I'm really passionate about talking about money, talking about finances, and I feel like finances are really taboo.
Yeah.
A lot of people just really touchy subject, don't want to talk about it. Even growing up, my parents were like,
I didn't know what my mom made until
I still don't know what my mom
I had
makes.
to get her to co-sign for something the other day.
Still don't know what my mom makes to this day. And I don't think I'll ever find out.
Yeah,
my dad just told me the other day because I did his mortgage.
Right.
And it's just like, I feel like having more conversations about money makes you more comfortable. It's healthy. You do better. Yeah. You do better by having conversations about things. When you improve in your relationship, you're having conversations on how to improve. 100%. When you improve at work, you're having conversations with your boss on what you can improve on. Having conversations is the key to maximizing in anything. And, you know, Flyynancial Solutions is just, you know, like a little play on words, just to kind of make your finances fly. Talk about it, improve on it, make it cool. Yeah. Like, make it cool again to talk about money.
Doesn't have to be a boring topic.
Doesn't gotta be. It's fun to have. Like, I had a blast talking about this today.
For hours, brother.
You know what I mean?
Questions and questions and questions.
And we gonna talk some more
scenarios and, you know, what if this and what if, you know what I mean? Because
exactly.
I'm a young guy just getting, you know, into the industry as well. Having these conversations, I'm asking for myself selfishly.
Right?
And if I have the questions, I'm sure the audience has these questions as well, right? You're here not tomorrow. Today
Saturday.
You're here on Saturday. What are you guys doing? What is that?
We're doing a little first-time home buyer seminar, also for some investors as well, because many people want to hear about the first property, but they also want to know about the second and third, because people have those aspirations, right? And again, like, even just kind of going back to the whole theme of why I do what I do, having the conversations, sharing the information, and all the people that we look up to in any space, like the celebrities, the millionaires, or whoever you look up to, they got there because they were fearless, had conversations, and were not afraid to pick people's brains.
Yeah.
You sitting there and not asking for information, not looking to, you know, learn about the next thing or take an interest in what it is that's going to get you to where you want to be, you're doing yourself a disservice and nothing more than that. So seminar on Saturday, we're just going to kind of share all the ins and outs, just the step-by-step process of how to get into your first property, you know, income, how that's got to look from a base level perspective, you know, credit, things that we talked about on this podcast, really just kind of conveying it to people who want to sit in this room with us.
You're going to be online with my boy Aziz.
Aziz, yes.
Yeah, he's from the brokerage as well. How do I get a ticket?
Hey man, I got the link for you. So I'm gonna drop that link. The link can, you know, I'll give it to you as well. It's a simple click away, and it's free. And that's the main thing that is so interesting about this space is there's plenty of spaces that yes, they cost money, but a lot of the information that is out there. It's
people just want to talk sometimes.
People just want to talk, and it's free.
Yeah.
Find the
networking events.
Pardon me?
I said find the networking events.
Exactly, and just show up. Like even for me, like how I even got that Sudbury property, there was a real estate investors link up in Toronto one summer, and they like linked up at like Lakeshore, like
make it vibey.
Yeah, and I pulled up, and I met some cool people that I still talk to this day, and everyone was just asking each other questions. Some people are there with 10 properties, some people are there looking to get there first, and everyone's just willing to talk. And it's funny because like the people who have what you want,
they want to
talk. They just want to talk. You know what I mean? So that's kind of like what I aspire to keep going as a trend, and why I take it upon myself to be so transparent. Yeah. Because there's no shame in it, and I want people to take what I did and 10x it. Like it's very possible.
You're on a prosperous path, my brother.
Thank you, man. Appreciate it.
Appreciate you coming out.
Thanks for having me.
And sharing all this information with me. You know, I'm gonna reach out to you, and I'm ready to do my thing as well, man.
Got you,
I feel like there's somebody I can get down with. You know
Appreciate
what I mean?
that, man.
If you guys are looking to get in contact with my boy Roy, you know, Flyynancial.Solutions. Hit him up on Instagram.
Yes, sir.
I appreciate you guys joining us today. Hit the subscribe button, all that like. It helps with the algorithm and all that jazz. And until the next time, peace.